The safe haven signal just failed. Not underperformed, failed completely. Missiles are flying. The strait that carries a fifth of the world's oil is a live flashpoint. Crude jumped 11%. Inflation hit a 3-year high. And gold, the asset human beings have run to for 5,000 years when the world stops making sense, fell through $4,000 an ounce. Silver got cut in half. Every alarm bell rang at once, and the fire extinguisher went down with the building. So here's the question nobody's asking properly, and it's the one that actually matters. What exactly is a safe haven? Because I think almost everyone watching this, including most professionals, has been using that phrase for their entire adult life without ever knowing what it means. And the definition they're carrying around is the reason they're confused right now. Let me show you what's really happening, because this is not a small technical distinction. It is the difference between holding the right asset through the wrong week and abandoning the right asset at the exact moment it was about to matter. A generation of savers has already made that mistake, in living memory, and I will show you exactly how it played out. There are two completely different things hiding inside the phrase safe haven, and confusing them is the single most expensive mistake in this business. The first is what I'd call a liquidity haven. That's where money hides for a week. When something terrifying happens, a pension fund with $2 billion doesn't ask what will hold its value over the next century. It asks, where can I park this by Friday without moving the market? And the honest answer, still, is US Treasuries. Not because anyone believes the debt is sound. Nobody serious believes that. Because it's the deepest, most liquid market on Earth. In a panic, liquidity beats philosophy every single time. The second is a solvency haven. That's where money hides for a decade. It's not asking, where's it safe this week? It's asking, what will still be worth something if the promises break? And that's gold. That is the only thing gold has ever been, and the only thing it has ever claimed to be. Those two are not the same thing. They're barely even related. And in a crisis, they compete. Because the reflex money runs to the liquidity haven first, and that reflex is what crushed gold. Watch it happen. War escalates. Institutions scramble for safety. They buy dollars, because that's what you do when you need somewhere to stand by the close. The dollar strengthens, and a stronger dollar mechanically pushes down the price of everything quoted in dollars, including gold. Not because anyone judged gold and found it wanting, because the world's cash needed a parking space, and gold isn't one. So the safe haven signal didn't fail. Two safe havens competed, and the one that clears in seconds beat the one that clears in centuries. That's the whole thing. Now, let me pause for a second, because if any of this is making you look at your own retirement accounts differently, that's exactly the right instinct. I put together a free guide that walks through how retirees are protecting their savings in exactly this kind of environment. It's completely free. The link's in the description, or just scan the QR code on your screen. It takes 2 seconds. All right, now let me show you the second half of the failure, because there's another force in this, and it's bigger. Gold pays you nothing. No dividend, no interest, no coupon, zero. That's not a flaw, it's the entire design. But it means gold's permanent competitor is a bond that does pay. And what gold actually responds to isn't fear, it's the real interest rate, what a bond pays you after you subtract inflation. Now watch the chain reaction that just ran. War pushes oil up 11%. Oil is an ingredient in the price of almost everything, so an oil spike is functionally an inflation event. And the moment the market smells inflation, it doesn't buy protection. It calculates. The central bank can't ease into this, so it stays tight. So yields rise. So real yields rise. So sell the thing that pays zero. And this Federal Reserve made that calculation easy. Chairman Kevin Warsh has gone hard hawkish. The market's pricing roughly a 65% chance of a hike, not a cut, and the odds of a cut have collapsed to about 2%. Nearly half the committee wants at least one hike before year end. A third want 2 or more. The minutes showed them split 9-8, one vote. So the war didn't send money to gold. The war sent oil up, which sent rate expectations up, which sent real yields up, which sent gold down. The crisis armed the one weapon that genuinely hurts the metal. That's not a signal failing. That's a signal you were reading wrong the whole time. And reading it wrong is not a small error of interpretation. It is the difference between understanding that your protection is doing precisely what it was built to do and concluding that you were sold a lie by people who never explained the mechanism to you in the first place. And there is a third force that almost nobody accounts for, which is that gold cannot be manufactured to meet a moment. You cannot conjure an ounce with a policy decision. A serious new deposit takes the better part of a decade to go from discovery to production. Exploration, drilling, permitting, financing, construction, ramp up. 10 years. And the big, easy, high grade discoveries were made generations ago. What is left is deeper, lower grade, in harder places, meaning miners move far more rock for the same ounce and burn far more diesel doing it. Which is the quiet joke inside this whole episode. The oil spike that triggered the selling is simultaneously raising the cost of producing the metal being sold. So hold the two halves side by side. On one side, a supply that physically cannot answer for a decade, and an official sector removing metal into vaults it never leaves. On the other, a price falling because a futures market repriced what 17 people might do at their next meeting. One is a fact about the physical world. The other is an opinion that can reverse in an afternoon. Now, let me show you the history, because this exact thing has already happened in living memory, and the people who misread it made the worst decision of their financial lives. Go back to the Great Financial Crisis. The banking system was genuinely coming apart. Storied firms that had survived world wars and the Depression vanished in a matter of days. If gold has ever had a moment to prove itself, that was it. And gold fell. Hard. Right in the teeth of the panic, gold got sold off violently alongside everything else. Why? Because when the margin calls came, people sold what they could, not what they wanted to. That's the rule in a liquidity crisis. Your worthless positions have no bid. Nobody will buy them at any price. So you sell your good assets, the liquid ones, the ones that still have a buyer. Gold got sold precisely because it was still worth something. It was collateral damage from its own quality. And the newsletters had a field day. Gold failed. Even in the worst financial crisis since the Depression, gold couldn't protect you. Ordinary savers read that, concluded they'd been sold a myth, and got out. And then, over the following years, gold roughly tripled. Read that sequence again, because it's the whole lesson. Gold's worst moment came at the peak of the panic, the exact moment its case was strongest. The people who judged it by that moment sold at the bottom of the greatest setup in a generation. They weren't wrong about the crisis. They were right about the crisis. They just didn't understand the difference between a liquidity haven and a solvency haven. So when the liquidity phase crushed their solvency asset, they concluded the thesis was dead. It wasn't dead. It was early. And early, for a retiree, is not the same problem it is for a trader. A trader who is early pays for it in losses on the position and answers for it every quarter. A retiree who is early simply owns some insurance for a while before the fire. Those are wildly different costs, and almost everyone in this market prices the first one while living the second. And that brings me to something that matters, especially if you're sitting on $100,000 or more in a retirement account, a 401k, an IRA, anything like that. Because this is exactly the kind of environment where the decisions you make actually count. I've put together a free retirement protection guide that covers the strategies retirees are using right now, including how some are moving a portion of their retirement savings into physical gold without triggering taxes or penalties, inside the tax-advantaged account they already have. It walks through it step by step, in plain English, and covers the mistakes that cost people real money. It's in the description, or scan the QR code on your screen. And if you go through the guide and want to go deeper, there's a free, no-obligation, one-on-one educational session available for folks with $100,000 or more in any retirement account. Just answers, no pressure, nothing to buy. Okay, now let me show you who's still reading the signal correctly. Because here's the thing about the liquidity haven. It only works if you believe the promise behind it. And the world is quietly, methodically, backing away from that belief. Nations have begun settling trade in their own currencies, cutting the dollar out of transactions it used to referee. The BRICS bloc has openly discussed alternatives to a dollar-based settlement system. And the moment that changed everything wasn't a policy announcement. It was the day foreign reserves got frozen in a geopolitical dispute, and every Treasury official on Earth drew the same conclusion on the same afternoon. Reserves held in someone else's currency are only yours until they aren't. That's the crack in the liquidity haven. Treasuries are safe until the issuer decides your treasuries aren't yours. And once a government has demonstrated it is willing to make that decision, no amount of yield buys the trust back. Which is exactly why the official sector, the institutions that manage the reserves of entire nations, has been accumulating physical gold at a pace we haven't seen in generations. Not paper, not futures, metal, in their own vaults, on their own soil. Ask yourself why people who can create currency out of thin air would hoard the one thing they cannot print. They're not chasing a return. Gold pays nothing. They're buying the solvency haven, while everyone else crowds into the liquidity one. They didn't stop when the price fell, because their reason for buying was never the price. It was the counterparty, or rather, the absence of one. Every bond is somebody's promise. Every deposit is somebody's promise. A bar of gold is the only major asset on Earth that is nobody's liability, and that is the entire product they are purchasing. You cannot buy that quality at a discount and call it a bad trade. And they're not the only ones. Right into this decline, UBS raised its 12-month target on gold to $5,200 an ounce, roughly 30% above where it trades today. Their reasoning? The market has the Fed mispriced. The dollar's position is stretched given the deficits, and central bank buying puts a floor under the price. They called this weakness a buying opportunity. And a cluster of major institutions published constructive gold analysis within the same week, right into the teeth of the selling. So look at the actual picture instead of the headline. Households and traders are selling the solvency haven to crowd into the liquidity haven. Governments are doing the exact opposite. One of those groups is graded every quarter. The other is planning for the next century. And there is one more historical case worth putting next to this, because it is the closest match to what you are watching. A generation ago, a different conflict erupted around that same region, and oil spiked hard. Gold jumped on the invasion, jumped exactly the way the folklore promises, and every newsletter declared vindication. And then, over the following months, as the war actually unfolded and got worse, gold ground lower and lower. The people who bought that spike spent years underwater. Why? Because the war was never what mattered. What mattered was the interest rate environment, and it was working against them the entire time while they stared at the headlines. That is the same machinery running today, and it is the reason a war can get worse while your protection gets cheaper. It has happened before, it will happen again. And every time, a fresh crop of people will conclude that gold is broken rather than that they were watching the wrong variable. Now, let me be honest about the risk, because I'm not interested in selling you a fantasy. The liquidity phase can run longer than you think. Real yields could climb further, and gold could get cheaper from here. If Warsh hikes and the economy absorbs it, and inflation genuinely breaks, gold stays under pressure. That's a real possibility, not a straw man. Nobody can give you the day or the hour, and anyone who does is selling something. But here's the asymmetry that matters at your age. The liquidity haven and the solvency haven fail in opposite conditions. Treasuries fail when the promise breaks. Gold fails when the promise is trusted and well paid. You cannot have both of those be true at the same time, which is precisely why owning some of each isn't a contradiction. It's the only honest response to not knowing which one is coming. And the danger to you isn't the price, it's the definition. Because if you believe gold is supposed to go up whenever the news is scary, then every crisis where it doesn't will feel like a betrayal. And you'll sell your solvency insurance during a liquidity event, which is exactly what happened to a generation of people in the last crash. If you're 30, that's a lesson. If you're at or near retirement and drawing on these accounts, that mistake is permanent. And watch what happened to the other physical buyers while this ran, because it tells you where we are in the cycle. Chinese buyers, who not long ago were paying premiums of 12 to 13% over the world price and importing roughly 790 tons of silver in 2 months, have gone quiet. Gold there flipped to a discount, and one Shanghai shop watched daily sales collapse about 90%, from 2 or 3 kilograms a day to a couple hundred grams. The stated reason was fear of a further fall and a wish for clarity. They paid up near the top and will not pay the asking price near the bottom. That is not a verdict on the metal. It is a photograph of what capitulation looks like while it is happening. And consider who carries the cost of getting this definition wrong. If you are 30 and you misread a liquidity event as a verdict, you sell, you learn, and you buy back in with the next decade of paychecks. If you are living on a fixed income, the same mistake is structural. You are already absorbing a 3-year high inflation in full at the grocery store, against a cost of living adjustment that arrives late and understates what you actually buy. Selling the one asset you own that is nobody else's promise during the exact phase where it is designed to underperform does not just cost you a return, it removes the only part of your portfolio that was built for the outcome you cannot afford. So here's where I'll leave you. The safe haven signal didn't fail. What failed was a definition, a cartoon version of gold, sold to ordinary people because it fit on a billboard. Gold was never insurance against bad news. Gold is insurance against broken promises. And right now, the world is running to the biggest promise there is because it clears by Friday. That's not gold losing. That's the liquidity haven winning the week, while the people who manage nations quietly buy the other one. If today raised more questions than it answered about your own savings, that free retirement protection guide is still in the description, and the QR code's on your screen one more time. It costs you nothing to be informed, and being informed is the entire difference between understanding what you own and abandoning it at the worst possible moment. And for those of you who stuck with me all the way to the end, here's something just for you. If you have $100,000 or more in any retirement account and you mention that you watched this full video, you can claim a free one-on-one, no-obligation educational web conference, a real conversation about your specific situation with no pressure and nothing to buy. That's only for folks at that level who made it all the way here, and you are one of them. Scan the QR code, grab the guide, and take the first step toward protecting what you spent a lifetime building. Because the signal didn't fail. You were just tuned to the wrong frequency.